Hello everyone. Hope you all are doing good. So I think from the title of the video, you are already in an understanding of what is this going to be. So yes, today I'm going to just quickly discuss about this topic called asset retirement obligation with you all with a slight suspense. Maybe we can have a second part. Um, so let's get started with the video. Um, so did you ever hear about asset retirement obligation? So let me just explain this concept to you. This is something which accounting students or people who are involved in accounting can easily relate to. I'm not sure if this can be heard outside the purview of accounting unless you are very much interested in the company affairs and what is going on with respect to the ESG, uh, the famous term which we are hearing from quite few years now. Okay, here I laid out some of the items to you. So this is the definition of asset retirement obligation, which I uh, tick- took from Investopedia. So let me read this out and then I can explain you the concept by giving some examples. So what is asset retirement obligation? In accounting, an asset retirement obligation describes a legal obligation associated with the retirement of a tangible, long-lived asset where a company will be responsible for removing equipment or cleaning up hazardous materials at some future date. AROs should be included in a company's financial statement to present a more accurate and holistic snapshot of the enterprise's overall value. So let's break this. First, let's understand what is the first point mean. Okay, so basically, if you take an example of somebody who is um, manufacturer of sugar, or we can just directly jump into this topic, which we can easily understand. So let's take an example of electricity company. Assume that the electricity company is generating the electricity with the help of nuclear power plant. Okay. So when we say nuclear power plant or something like coal mine from where they are generating electricity, those are the power plants, right? They generate a lot of waste, which is hazardous for everyone. So when they are doing that work, and once the power plant capacity is fully utilized, they have to dismantle it. The land in which that is being operated should be clean, should be brought to its original state. All of those should be done, right? So it is a legal obligation. It is something which is not out of good faith, but it is something which they should do. It is a obligation. They are obligated to do certain things to bring that piece of land to its original state, to make sure that the environment is not going to get affected because of their operations, right? So all these kind of expenses which the company is going to incur at a future date, it might not be something which it is going to pay today, but it is something which is going to be paid at a future date. But the company is aware about that particular amount being paid, right? So this is asset retirement obligation. And when can you recognize this? When can you recognize this is only when you expect or estimate the amount which the company is going to incur at a future date. Only then you can recognize this. That means you need to have a ability to estimate the fair value of the future outflow on account of be it removing the equipment or cleaning up the hazardous materials. Okay, that is about the first point. Now, second point, AROs should be included in a company's financial statement. Why do we need to include the ARO? We can say that, this is an expense which is going to be incurred by the company in future date. So why should we incur it today only? Why can't we just account for the amount in the year in which it incurs? So there comes some of the topics which are basic to accounting. First thing, it's a if you're going to incur, if you're going to account for when it is incurred, we are seeing that we're going to follow cash system. But the basics of accounting says that we should follow accrual system. Okay, when we follow accrual system, you should accrue for a cost as and when it is incurred, not as and when it is paid. Okay, and then you can see that, but here we are only incurring it in that year, right? It is not only being paid, it is being incurred also in some future year. Let's assume it to be 10th year. Then comes another point. Basically, the power plant which you are using to generate the electricity, you are using the power plant from day one. You are not using the power plant only in 10th year. So when you are using the power plant from day one and it is being lasted till year 10, that means the usage is segregated over the period. So when the usage is segregated over the period, the corresponding expense should also be segregated over the period. That is a matching concept, right? So because of all these things, and you can't just have a liability. I mean, you can't just recognize a liability in a after 10 years and say that now only we got to know and we are going to pay it. That is not how it works. Matching concept is being revoked at that time, right? So what we need to do, as and when we get to know what is the amount which the company is going to incur at a future date, we need to create a liability on that day itself. And by creating a liability, we are making sure that the company is not having some unforeseen expenses suddenly. The company is prepared to see that outflow in that period. And then, you can get confused about the accounting. So when you are saying that the liability is to be created, how are we going to pass the journal entry for that, right? So now let's go to the accounting concept of asset retirement obligation. So this is the initial recognition. Initial recognition means the first time when the company assess that asset retirement obligation is to be recognized. This is what the procedure which it follows. And this is an excerpt from PwC audit guide. Let's read this out. What is it saying? Asset retirement obligations are initially recognized at fair value in the period in which they are incurred, and the amount of liability can be reasonably estimated. You should highlight that reasonably estimated. And then determining the appropriate timing of recognition may be complex if the ARO arises over a period of time or due to change in laws. For those AROs arising from changes in laws or regulations, the ARO should be initially recognized in the period the law or regulation is enacted. Once a reporting entity has determined whether a duty or responsibility exists upon retirement, it will then need to assess whether an obligating event has occurred that leaves it little or no discretion to avoid the future transfer or use of assets. Once that obligating event has occurred, an ARO meets the definition of a liability and qualifies for recognition. So, when we are saying that we need to recognize ARO, we should only recognize based on this guidance. So, what is it saying? First point says ARO can be recognized at a fair value in the period in which they are incurred, and the amount of the liability can be reasonably estimated. So, as we discussed previously, ARO can be recognized only when we are able to estimate the fair value of the amount which is going to be incurred in a future date. And we should be able to reasonably estimate. It should not be irrational assumptions or illogical assumptions which we should take, right? That assumptions, whatever assumptions we are going to take, should be in a prudent way. And the next point is saying, like, in some cases, um, you won't, you will be seeing a lot of new obligations which the company need to fulfill, right? Based on some new laws. So what it is saying is, if you see those things happening, you will be recognizing an ARO only once the law is enacted. That means the law is in place. Only then you are obligated to recognize the ARO. Okay. And the second para, what it is saying, once a reporting entity has determined whether a duty or responsibility exists upon retirement. Here, retirement means dismantling of an asset or retirement of an asset, or, disposal of an asset. You can think about as a sale, or the asset's life is over, like that. Okay, an entity um, has determined that it has a duty or responsibility, then only it will need to assess whether an obligating event has occurred. So that means, the entity may be involved in generating electricity. It might be having nuclear power plant, but if it's having some other power plant, some other renewable source from which it is generating electricity, and it is not using its nuclear power plant, do you think then also it is obligated to record a ARO? No, right? Because it is not using its nuclear power plant. So it is not causing any damage to the environment in the first place. When it is not creating any damage, it is not having any obligation to pay some amount in the future. So we should be aware about that as well. And here that is only mentioned in the case of a nuclear power facility, an entity assumes responsibility for decontamination of that facility upon receipt of the license to operate it. However, no obligation to decontaminate exists until the facility is operated and contamination occurs. That means even if the entity receives a receipt of license to operate the nuclear power plant, it need not recognize any ARO until and unless the operations started. Therefore, the contamination, not the receipt of the license, constitutes the obligating event. So in this case, what we consider the obligating event as? The obligating event is when the operations starts, when the contamination occurs. Okay. Now, let's see an example here. Let's assume that the nuclear power plant life is 20 years. In year 20, the dismantling or decommissioning charges amounts to $5 million. Okay. And I am assuming the accretion percentage as 10%. So, and again, coming to this concept, accretion percentage. So what we are going to do here is, you are saying that in year 20, you are going to incur $5 million. Do you think $5 million today is equivalent to $5 million in year 20? They are not just cardinal numbers, right? You should also think about the economy, the inflation in the economy. the decline in the dollar value over a period of time. And if you just take an example about um, 10 years back, $1 or 1 rupee is not $1 or 1 rupee on this day. There is a decline in the value. So we need to factor in that as well when we are creating an asset retirement obligation. So I am considering the inflation percentage, or I can say, instead of accretion, what I will say is discount rate. Okay. I'm considering the discount rate as 10%. So what I need to consider is I need to consider the present value of 10% in year 20. You can just Google about present value factor table and you will be able to see this number. So I took the number from there. The present value of 10% in year 20 is 0.149. So what I will do is I will multiply this 5 million with this 0.149. So if I do that, the asset retirement obligation which I need to recognize in my books of account today is going to be only 745,000, not more than that. Okay. So let's see this. Let's see the journal entry. So when we should pass the journal entry? We can pass a journal entry once we are able to reasonably estimate this 5 million amount. Okay. Normally in the year one, if you are able to estimate it, you will be passing it in the year one only, or the year in which the obligation is recognized and the fair value is assessed, whenever is the case. So what I'm doing here, I'm debiting asset retirement cost and crediting asset retirement obligation. So far we understood that we are going to recognize a liability, and the liability asset retirement obligation we recognized, and we are happy with that. So how are we sure with this debit amount? Why are we debiting this? What is this? Let me explain this to you. So we already discussed about matching concept, accrual concept, all of these, right? So I can't just book an expense for entire 745,000 in the year one, because this is something which is going to happen at the end of year 20, right? So I can't do that. So what I'm doing, I am creating an asset which I will be depreciating over the life of the power plant. So I will be depreciating this over the life of the power plant, that is 20 years. In that way, I am ensuring of the matching concept. Okay. This is the initial recognition of asset retirement obligation. Do you think we can stop at this point? Or, the liability we recognize is not equal to the amount we expected to be paid in year 20. What is the reason? How are we going to fill this gap between this 5 million and 745,000? How are we going to fill the gap? All those things we will be discussing in subsequent recognition, which will be there in the next video. But please comment your views, your answers on these questions. Thank you so much for listening.